Hey, everybody. Happy Friday. Phil Hodgen here. Welcome to the Hodgen Law PC International Tax Lunch. We do this almost every month on the last Friday of the month, noon Pacific time. We skip over if the last Friday, when we collide with filing deadlines. You can listen online. You're doing that now, or you can watch it later on YouTube when we post it up. Anyway, this month is the 9 filing categories for Form 5471. So item B has a bunch of check marks, and the problem you have is after you put in the name of the taxpayer, say, the hell do I put in item B? Which boxes do I check? So that's what we're going to talk about today. And just to foreshadow something that I'm going to be talking a lot about, and I'm going to be hand waving at attribution rules, constructive ownership, indirect ownership, and all of that fun stuff is critical for deciding which of these boxes you're going to be checking. Next month, September 30, will be an in-depth review of the indirect constructive ownership rules, blah, 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 for Form 5471. So if I skip over stuff this month, it's because I'm going to be covering it next month. Oh, for God's sake. There we go. Introduction, the beginning. So here we have the magic form, and this is what you are going to be answering. These check boxes, which one of them will apply to the taxpayer for whom you're preparing an income tax return? Maybe none, maybe multiple. And here is this little diagram that shows you the evolution of what used to be 5 filing categories for Form 5471, and then it metastasized into 9. And in actual fact, for a long time, there were only 4 because Category 1 applied to stuff that had become dormant 20 years ago. So there was no such thing as a Category 1 filer. But Category 1 was resuscitated from the dead by the Tax Cuts and Jobs Acts of 2017 and repurposed for Section 965. So that's why this little noose is around our neck for several more years. And you can see that the Category 1 and Category 5 are the only ones that change, and they split off into 3. So 1 became 3. In both cases, Category 1A and 5A, that's the old Category 1 or old Category 5. And B and C exist purely because Congress, in a fit of wisdom, decided to repeal Section 958B4, which is downward attribution stuff, and the collateral damage from that, which was then partly fixed in RevProc 2019-40. So that's why all of this happened. And we'll sort of march through it as we go along. And the importance of knowing which box to check, and you can indeed and quite frequently will check multiple boxes, is in the instructions, there's this table, and it goes much lower than this. It tells you if you are Category 2, these are the parts of the Form 5471 you fill in, and these are the schedules that you attach. And you can see that the requirements vary wildly from one category to the next. And Category 4, just so you know, is the evil one that you don't want, unless you love filling in schedules. So, and the whole game of item B, what filing category is, you're going to have to know in a really intimate sense these definitions for subpart F purposes. Subpart F in the code meaning section 951 through 965, and that includes subpart F income. It also includes our dear friend global intangible low taxed income, which is section 951 cap A. Anyway, so we have these defined terms: U.S. person, U.S. shareholder. What's a corporation? What's a specified corporation? What's a foreign corporation? What's a controlled foreign corporation? And some other little fiddly details that are spawned by RevProc 2019-40. And you're going to have to really understand those well in order to understand which box to check. So let's start first with the shareholder. So this is going to be the taxpayer for whom you are preparing Form 5471, or maybe you're going to find out that Form 5471 need not be completed, which will make you happy. The very first thing you have to know is your taxpayer a United States person or US person? Same diff. And it applies across all categories, categories 1 through 5. It explicitly applies for categories 2, 3, and 4 because it says if a US person, blah, 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 then you're category 2. It also implicitly applies to categories 1 and 5 because category 1 and category 5 apply to US shareholders, but by definition, a US shareholder is someone who's a US person and who owns a sufficient amount of stock to make that person a US shareholder. So the standard definition of what a US person is a section 7701A30. But why have one definition when you can have multiple? And as you'll see when we talk through categories 2, 3, and 4, US person has a different definition for those reasons than it does for the rest of the Internal Revenue Code. So this is what US person is defined to be, one of these people or entities. And for an entity, it's really, really simple to figure out. You look at the organizing paperwork for this thing, articles of incorporation for a corporation. If it says state or DC, then you're done. So this is usually not a problem. And the other reason it's not a problem is if it's landing on your desk for Form 5471, somewhere upstream of you, someone has decided that this is a US taxpayer. The second thing that you need to look at, and this is more touchy than, are you a US person, is are you a United States shareholder or US shareholder? And here the question is, there's a standard definition of what a US shareholder is. And there are some embellishments here and there as you might expect. And U.S. shareholder status is irrelevant for categories 2, 3, and 4 because these are situations where, for whatever reason, the code just defines the filing trigger as a U.S. person rather than a U.S. shareholder. So the definition of U.S. shareholder from the code is a United States person. There you go. So you have a domestic taxpayer who owns 10% or more of the stock of the company by vote or value. And the important thing here is this magic 10%. How do you figure that out? And this is where you have exquisite moments of pleasure looking at attribution rules, looking at organization charts, and trying to figure out whether humans are related or not related to each other for purpose of the attribution rules. Hence, again, pimping next month's session on September 30, 2022. Come and learn all about that. So the main thing I can tell you, and I can tell you this from personal painful experience, is before you start any serious work on this kind of project, make an org chart. Identify everybody all the way down to names. If you've got humans, where do they live? What are their citizenship? What's the relationship between that person and the taxpayer for whom you're preparing a tax return and possibly a Form 5471? If there are corporations, I can't tell you the number of times that I've started with a new client where you get a sketch on a napkin. This is the organization chart for my company. And the percentage of ownership is wrong. The names of the companies are wrong. Everything is wrong. And this is either because they're in a hurry or because they thought the company issued shares, but it never did. I meant to give my cousin 40%, but in fact, I'm still the 100% owner, that level of stuff. So spend whatever time it takes to get this thing right and get it approved by the client. And then and only then are you going to feel comfortable moving on to the next step of figuring out what filing category you have and indeed preparing the rest of the Form 5471. The other little piece of painful information I would highly recommend is if these people are telling you ownership by percentage of companies, do not accept that. Please find out how many shares. If they just say, I own 52% of the company, you might or might not find out about there's a second class of preferred stock or something like that, and which may not matter to them in the real world, but for your purposes, this 10% by voter value might be critical. So you need to know what they own, number of shares. You need to see the articles of incorporation to see the classes of shares that are authorized to be issued and confirm that you know reality. Ask me how I know. Anyway, so that's your shareholder. And now let's look over at the corporation, because remember, when this game we're playing is we've got a taxpayer who is a shareholder in the eyes of the IRS, and a shareholder of what? This thing. And so if you have the right kind of shareholder in the right kind of thing, namely controlled foreign corporation, you got a Form 5471 problem. So let's look at the corporation side. The first thing to look at is it even a corporation? And I'm just saying, do not be lulled into complacency by the little magic letters at the name of the end of the name of the company, particularly LLC, which I've seen again and again, where people say, "Oh, LLC has two owners." Around here in these parts, that's a partnership. Well, for foreign entities, the default assumption is that if all of the owners have limited liability, the foreign entity is classified as an association taxable as a corporation. So what do? You've got that. So if you've made that determination, until you can see a Form 8832 that was filed and a letter back from the IRS saying, "Hey, Chief, got your letter. You're indeed going to be elected to be classified as a partnership," you got to assume it's a corporation. At the last page, I think it is, of the Form 8832 instructions, give you a list by country of the types of entities in those countries that are always going to be classified as a corporation and never can be anything else. Everything else that is from that country can elect to have something else with the check the box elections. And you may choose to do that because it may make your life easier. But this is a practical problem. And let me just say that, you know, I might have seen once that somewhere in the last couple of years of tax filings where we had a foreign LLC that the tax preparer just assumed was a partnership, filed as such foreign partnership for years and years and years without benefit of a check the box election. And what we did to fix that was to create an LLC in Delaware, do partnership merger upstream. So now the downstream little domestic entity became a disregarded entity, reported as such on the tax return, then dissolve the disregarded entity overseas and tiptoe silently away. So now we have all the assets in a domestic partnership, which had it before and after had two U.S. persons. They thought they had a partnership. In fact, they had a controlled foreign corporation, and that would have been disastrous for compliance purposes and penalty purposes. So, if you have an LLC, uh, it's probably a corporation. Now, so now you've gotten away from the default classification. We're still in the category of, do you even have a corporation? Because if you don't, you're filing some other form, not 5471. And this is dual chartered entities. This is kind of cool stuff, and it's useful now and then. Basically, when you want to move assets from foreign to domestic, or you want to do a merger, but you want to accelerate the paperwork, you can take a foreign corporation. You can go run over to the Secretary of State in Delaware and register that foreign corporation in Delaware. And now, hey, presto, what you have is a corporation that's the equivalent of an individual that has dual citizenship. It's simultaneously a Delaware corporation and a foreign corporation, which is all sorts of interesting because now you've got an 1120 with a balance sheet shows all of these assets of the foreign corporation on the 1120, and this is cool. So domestication, that's the sort of jargony word that you can ask Mr. Google for if you want to find out more about this. It's useful sometimes. As often as not, you can form a parent corporation in Delaware, then do a cross-border merger. It's no big deal. It's an F reorganization, is what it is. Um, so for your purposes, if you come across one of these things and you're trying to figure out, do I have a Form 5471 filing requirement for this, you know, dual citizenship corporation? The general rule, and you can see the site to the regs down there, is if it must be a corporation in either of the jurisdictions, you got a corporation for Form 5471 purposes. If it is eligible to check the box and be something else in both places, you can go choose your own adventure, check the box, and make it whatever you want. So I don't use these frequently. I use them usually in merger reorg situations where expedience matters. I'll give you one real life example where it might be useful to you. Um, Non-resident dad forms C corporation, forms a foreign corporation, buys a bunch of rental property in a foreign corporation. Bad. What we do is reorg dual status into Delaware and then dissolve the foreign corporation in Delaware. Now dad owns a domestic C corporation that has a bunch of rental real estate. Son, hypothetically speaking, came to the United States to go to engineering school and never left. And so father has son who is a US resident for income tax purposes, live here, and he wants to give all of this real estate portfolio to son. So now you have a gift of domestic corporate stock from foreign father to domestic son, tax-free gift. And now son makes an S corp election and goes on his merry way. And you've successfully, without any gift tax and any unpleasant income tax results, you've moved all of this real estate portfolio in the United States to the son. So there's an example in real life where it makes sense. Foundations are the other weird thing. And I've given you a citation to this Chief Policy Memorandum 2009-012. You can take a look at that. And the basic idea is if you have a foundation, the Internal Revenue Code really doesn't know how to classify it as a business entity or as a sort of passive holding thing that behaves and should be classified as a trust. And in general, it's a kind of facts and circumstances-y kind of thing, where if it's just sitting on assets and for the benefit of somebody else, it looks like a trust and classified as a trust and do compliance as a trust. If it steps up into more active business-like behavior, then the government is inclined to look at it as an association taxable as a corporation. So if you look at this word Anstalt, that's more a business-like activity. The inclination is go that way. The Stiftung is more likely to be a sort of passive trust-like situation. But you and I don't like more likely, right? Because our job, like all, if you look at what a tax lawyer does, a tax lawyer is looking forward to litigation in tax court against the IRS. And if you look at a structuring job as, hey, I get to create my own evidence that I can introduce at trial in front of a tax court judge and win, then what we're going to do is we're going to engineer the evidence that will make us win, depending on whether we want this thing to look like a trust and be taxed like a trust and do compliance like a trust, or vice versa as a corporation. So what do you do in a situation? Well, if you got an 80-20, it's probably going to be a trust. You can just start filing and, you only live once. And frankly, it'll probably work. So if you assert the trust structure for Stiftung, it'll be fine. And whether it's a grantor trust or it's a non-grantor trust, foreign in both cases, depends on the facts, but odds are it would work. But if the stakes are high, odds are it's going to work is probably not good enough. So I'm just going to give you a hypothetical idea. Let's say that you make this foundation relevant for US tax purposes. And what you do is you just put a tiny little US asset in there. And then you file Form 8832. Well, the 8832 for this thing is either going to be accepted or rejected. Why will it be accepted? Because the government thinks secretly this thing is a corporation, therefore a foreign business entity. Therefore, it's going to accept your check the box election to reclassify this foreign business entity as a partnership or as a disregarded entity, depending on the number of owners. On the other hand, if the IRS says, no, I'm bouncing your Form 8832, why will they do that? Well, they'll do it because you're not a foreign business entity that's eligible to make a check the box election. So cool. In either way, you've kind of forced an answer. You've forced a result. The IRS bounced me, said I'm not a business entity, therefore I must be a trust. Yay. That's okay. We just have flow through to the beneficiary and we're done. On the other hand, they accept it, and you've got the letter back saying, congratulations, this thing is a partnership for US tax purposes. Again, cool. You got 8865 and income flows through, and you know what to file. So you don't have to do stuff like this. I'm not saying it's going to be absolutely bulletproof, but it's going to be certainly better than YOLO, in life. So we've got a corporation. Let's just assume that we've got that. Now the next question is it a foreign corporation? And foreign corporation just means it's not a domestic corporation. So you get the articles and you look on it, and if it says one of the 50 states, or it says the United States, God forbid you're representing a bank that says N.A at the end of it, or Washington, D.C., the District of Columbia is a state too for this purpose. If it says anything else except those, it's a foreign corporation. Next thing is specified foreign corporation. So this is a creature of category 1. This is spawned by section 965. I expect that we will see this for a few more years while people work their way through the 965 transition tax payment and all that stuff. As soon as you wash the E&P out of the corporation, you lose the necessity, you lose the status of being a specified foreign corporation, and you're not going to have to worry about category 1 anymore. And so, when they introduced this in 2017, in some situations you could wait, pay the tax liability over 8 years. So when that's gone, for most of our lives, we're going to be out of the woods. There are going to be a few people who forgot this ever happened in 2017 and so didn't do it. And they'll need to come to Jesus, and that's going to happen for a few more years. So unfortunately, we can't erase this completely from our memory. Finally, another one you need to look at is it a controlled foreign corporation? And this is a category 5 problem. It also indirectly is a specified foreign corporation category 1 problem, because one of the types of specified foreign corporations is a controlled foreign corporation. And as a practical matter, category 4, as we'll see, just the way it's phrased is by definition, if you're category 4, you're a controlled foreign corporation. So those are the players, the who and the what. And here's my little diagram. So when you are solving the item B, what box do I check? You are trying to find a who of a what. So category 1A, a U.S. shareholder, we know what that means, U.S. person with 10% or more of the stock, of a specified corporation, and we know what that means, and I'll tell you more in detail when we come to it and talk about category 1. Anyway, this is your sort of matrix to figure out what definitions need to apply from the Internal Revenue Code and administrative effluvia from the IRS to check which box. And I just want you to see category 5B, foreign controlled foreign corporation. In RevProc 2019-40, they call it for foreign controlled CFC, but I wanted to write it out in full and not use the abbreviation just to mock them for what a silly definition this is. Okay, let's get into the details. Category 1. So here's the little blurb from the instructions. And you are looking here for a U.S. shareholder, remember, U.S. person, 10% or more of a corporation, of a specified foreign corporation, which is purely a definitional creature found only in section 965. And you're going to keep filing as long as you have these E&P items on Schedule J or Schedule P. So your objective in life should be do whatever is possible so that there is no such E&P on the books of this specified foreign corporation, because then you can stop being a Category 1 filer and you can go on with the rest of your life. So U.S. shareholder has an ownership element, 10% or more. It also has a time element. So the 10% or more means at any time during the calendar year, but Category 1 also demands that you own the stock at the end of the year. So you can see the little excerpts from the instructions that's it. End of the year does not necessarily mean the end of the fiscal year or the calendar year if that's the fiscal year of the foreign corporation. It means the last day on which the foreign corporation was a specified foreign corporation. So if you're a U.S. citizen and you own 100% of the stock of a specified foreign corporation and you sell that stock on October 30, that's the last day that the specified foreign corporation was a specified foreign corporation. Because on October 31, some non-resident owned the stock and it's no longer a specified foreign corporation. So we're not talking about December 31 or the end of the fiscal year, where it's a sort of combination of either the end of the fiscal year and you're still a shareholder, or you terminated your status, or you were a 10% shareholder and you sold 5% and now you're no longer a U.S. shareholder, that kind of thing. So the two things that make you a specified foreign corporation are either the foreign corporation is controlled foreign corporation, or a U.S. corporation was a shareholder in this thing. So that's pretty mechanical. You can figure that out whether you've got one of these Category 1 specified foreign corporations. So why was Category 1 split into ABC? So Category 1A is the old Category 1, pre-RevProc 2019-40. Category 1B and 1C are a result of the attribution rule creating problems for a taxpayer who really truly wants to comply with the filing requirements for Form 5471, but may not have access to information to prove this thing is a specified foreign corporation or a foreign corporation, and or may not have access to information to figure out how much income should be flowed through and drop onto the U.S. shareholders' tax return. And so, as we'll see, I'm going to glomp all of the discussion of the details later when we talk about Category 5, because the same rules apply to to Category 1 and Category 5. But that's the idea. How can you deal with information lack and at the same time present a decent, I'm not going to say perfect, but a decent Form 5471 to the IRS. And you can see I've just highlighted here that depending on whether you fall into 1A, 1B, 1C, the schedules you have to attach are different. And the idea of different schedules falls into the category of how likely does the IRS think you are to be able to get access to the information that's necessary for a particular schedule. So Category 1A, the old Category 1. U.S. shareholder, defined term, of a specified foreign corporation, defined term, who does not fit into 1A, 1B, or 1C. So in other words, it's the default residual category. Categories 1B and 1C, I'm going to talk about this later, and then I'm going to give you a little example of the downward attribution and how it pushes a taxpayer into Category 5C, but the equivalent will apply to 1C. But you can see it's littered with nuances, let's just put it that way. You know, the question is, you're a U.S. shareholder. Well, that means you own 10% or more of the stock, but do you own the stock directly? Do you own it indirectly through a holding structure? Or do you own it constructively by attribution from someone else? These are nuances that make a difference. And then the second bullet point down, this question of related, like how close are you to the center of the universe in this little corporate structure where you can reasonably be expected to have enough clout to get the information you need. So that's category one. More about it in a little while when we get to category five. Let's get to categories two, three, and four. These are unchanged since forever. And so we'll sort of bip along so we have more time to talk about the fun of RevProc 2019 40 later. So, category two, think of this as the Internal Revenue Service and our dear, lovely public servants in Congress have appointed U.S. people who are officers and directors of foreign corporations as rats to rat out other U.S. citizens and residents who acquire stock in foreign corporations. And if the officer doesn't do that, the officer has pain. So this is forcing you against your will to be a whistleblower. So the first thing is, are you an officer or director of a foreign corporation? If so, you must file Form 5471 as a Category 2 filer when a U.S. person acquires stock in that foreign corporation. It's not disposition, unlike Category 3. This is only acquisition of stock. So, and it applies to any foreign corporation and not just a controlled foreign corporation. So you could just be a wage slave in some foreign corporation somewhere, not, but you have a title, you're an officer, vice president or something like that, and you're not a shareholder. And this thing is not a controlled foreign corporation because it has no US shareholders whatsoever. And then private equity dude comes in and buys 10% of the foreign corporation stock. This is a triggering thing, and you, as vice president of this foreign corporation, have to file Form 5472. So, U.S. person. Here, I want the purpose of this slide is to flag the fact that you think you know what the definition of a term means in the Internal Revenue Code, but you really don't until you nerd out in the weeds of the regulations. So for category 2, what they do is they import the default code definition of who is a U.S. person for U.S. tax purposes from section 7701A30, and then they supplement it by these three different categories of other people that you might not necessarily think are, quotes, US persons, close quotes, for category 2 filing purposes. Bona fide Puerto Rico resident, bona fide resident of a possession of the United States, and non-resident alien who makes one of these 6013 elections. So this is a situation where you have a non-resident alien married to a U.S. citizen or U.S. resident alien taxpayer, and the non-resident alien chooses to elect under these code regulations to be treated as a U.S. taxpayer, usually so they can file married filing jointly. But there are other reasons that you might want to do it. So the moral of this story and the moral of this slide is don't let your brain go to sleep. Poke around. Yeah, if the I guess the meta moral of the story is if you choose to be an officer or director of a foreign corporation, be damn sure you know everything that's happening on the share registry. And when you look at the names on the share registry, be damn sure that you know what's happening for attribution rules, constructive ownership, and all that stuff. So you know exactly the reality of the stock ownership of this foreign corporation. Otherwise, you're going to be on the receiving end of a $10,000 penalty. Now, what makes you an officer director? I don't know. I've never seen anything definitive that makes you an officer director. Nominally a title, but like back in my prior lifetime, I worked at a giant multinational bank, and I was a vice president, mostly because I had a law degree, but and no other power at all. But there were 12,000 vice presidents in this bank. I mean, does that make me an officer or director of this bank for Form 5471 purposes? It was a domestic bank, but had it been foreign, would I be an officer or director? I don't think I should, but technically I might, right? What if I was a senior VP? What if I was an executive VP? What if I was a president? Well, at some point up this ladder of importance for titles, you morph from being just a lowly slug, which I was, into somebody who had some corporate power and therefore I would think has the obligation to check the box for category two, depending on what happens. And then at the other end, you have people who are sort of retired out, but they keep some sort of figurehead title for the corporation because they're the founder or something, chairman emeritus, or I don't know what. I don't. There's no real answer here. So I would say again, create the facts that you want to govern. My routine advice for people who are in this position is if you are a US citizen or resident, never, ever, under any circumstances, become a person with a title on this company. Just be a wage slave. Just collect a salary, be done with it. You might have practical power, but never take a title. And then what stock transfers? There are these trigger points, 10%, 10, 20, 30, 40. And every time a US person flips over one of those thresholds, you've got a filing requirement. So here you have the list. And again, it's just acquisition of stock. It's not disposition that cause you to have the filing requirement as an officer reporting on somebody else doing stuff. Um, Again, why have one definition of attribution rules and constructive ownership when you can have multiple? Don't put your brain to sleep and apply Section 318 in this context. You can see at the bottom the constructive ownership rules for Category 2 are in the regs under Section 6046. So be careful there to apply the right ones. And the moral of this story is, of course, know everything about your shareholders. Again, just to reemphasize, I would suggest that you finesse around this by never ever taking title of officer of any kind, even a lowly assistant vice under president. So, category three, this again is a transaction driven filing requirement. It only exists not because of your ownership, but of a transaction of enough stock, acquisition or disposition in the corporation. And this is where you tell on yourself, not somebody else telling you, but you self report. Again, the same thing. Sorry about the typo in the middle column. It's category three, not two, but the same rule applies. And this is, again, we're talking about people who are shareholders that, in addition to the normal definition of a US person, you've got these Puerto Rico residents, you've got possessions residents, and you've got these people who make these 6013G or H elections. So, yeah, be suspicious, check out everybody to make sure that nobody's moved up and down. Now, this is for category three is for yourself. So, in theory, you would know whether you're a Puerto Rico resident or possessions. You'll know whether you made the 6013G election or not. You'll know if you're a domestic corporation, for instance, or not. So this is going to be a little bit less problematic because you're at the source of the knowledge because it's about yourself rather than an officer who may not be at the source of the knowledge and may find things happening behind his or her back. So this is acquisitions and dispositions, and it's a 10% incremental movement that we're talking about. The bottom bullet point, super, super important, and I've seen any number of these. You have someone who owns the stock of a foreign corporation, lives outside the United States, has never touched the US tax system in his or her life, immigrates to the United States, and you're filing the first year resident return for that person. That is a trigger moment for category three of Form 5471 because they changed from non-resident to resident alien. So they, quotes, acquired the stock that they owned before, but now they acquired it as being a resident alien. Anyway, the section 6046 specifically calls out this fact circumstance for when you're required to file category three. There are some hidden ones, and I'm just get a few here that you should kind of be suspicious about and look for. The obvious one, of course, is non-resident alien family members. So if there are related parties who acquire stock that might magically be yours through constructive ownership, maybe that's going to push you over the 10% threshold, or maybe they sell and that pushes you under the 10% threshold because of the attribution rules. Um, Check the box election. You make a check the box election. Guess what? Let's say you go from check the box election, foreign corporation to disregarded entity. You've disposed of 100% of the stock of the corporation. So on the form 5471 for the last year that this thing was a foreign corporation, you're going to check the box category 3, in addition to spawning a form 8858 because now you're the sole owner of a foreign disregarded entity. I mentioned non-resident to resident alien status shift. Another interesting slash bizarre one is you have a non-resident alien who owns hypothetically 100% of the stock of a foreign corporation. A US person marches along and marries her. Okay, now the attribution rules say that the stock owned by a spouse is owned by the US person. Guess what? You constructively own that stock. Therefore, in the year of marriage only, you're a category 3 filer. For all other years, you're not a real shareholder. Probably you're not going to fall into any of the other categories. So it's just a one-time thing. And you file your form 5471 and you move on with life. In the good old days, I used to file these years late, and with a letter of explanation, the IRS would just accept them and they would go on their way. But in the current reality of our kinder, gentler IRS that's going to buy 5 million rounds of ammunition, I'm not bitter about that. I think the government is inclined to spawn automatic $10,000 penalties at you if you try to fix the messes of your past. And I would be reluctant to advise someone to file a delinquent Form 5471 strictly for the Category 3 purpose, unless you could push them through one of the streamlined procedure windows, for delinquent information forms and no penalties if you just confess your sins and come to Jesus, which exists for right now, but it'll go away at some point. But this is something you see again and again and again. Reorgs are another situation, or stock redemptions. I mean, let's say that you own 9% of the stock of a foreign corporation. Some other shareholder's stock is redeemed, and suddenly you own the same number of shares, numerator, over fewer outstanding and issued shares, denominator, and you're above the 10% threshold. Then you've got a category 3 problem. Category 4. Category 4 is a US person who controls a foreign corporation. So note what's not here, but it's here by implication. US shareholder does not appear here on the definition, and controlled foreign corporation does not appear here on the face of the definition. Again, we've got this traditional, different diagrams showing the different definition of US person for category 4 purposes. And again, we have the Puerto Rico, the possessions, and the non-resident with the 6013 elections. So work with that. And those are the people that you're looking at in terms of trying to decide whether you've got a category 4 filer or not. Control. So control means that you own more than 50% of the stock entitled to vote. Okay. Well, if you own more than 50% and you're a US person, you're a US shareholder, right? So because 50% is more than 10%. So by definition, anybody who is a category 4 filer is also US shareholder. Again, control means temporal. So at any time during the tax year, did you own more than 50%, even for a fleeting moment? And this one can sometimes get you, and particularly in the situations possibly with reorgs and stuff like that. More than 50%, the critical element in this is Section 318, which are the constructive ownership rules that you're going to apply. And there's some modifications in the regs to the 318 rules that you're going to have to look at as well. So that's the real game. And this slide here tells you the real problem that you're going to face in trying to decide whether you have a category 4 filer. Now, if your brain is like mine and is just littered with the debris of a few decades of tax practice, you have these memories of rules that used to be and no longer are. And so these are the ones that don't apply. So, you're reflexive. Oh, I got a 5471. And, do I have to own stock on the last day of the tax year? No, not for category 4. That's category 1 and 5. There used to be a rule that said you had to own the stock for 30 days in a row. Well, that rule's gone. So you don't have to worry about that. But yet my brain still hangs on to that 30-day rule. And sometimes it kicks up and I have to remind myself, oh no, that's gone. And the other one is we get all creeped out about the repeal of Section 958B4, the downward attribution stuff. Not to worry for category 4, because 958B4 never applied to category 4 and its reporting requirements. So repealing it didn't make a difference to category 4 and its filing requirements. So what are we going to say about category 4? U.S. person, again, the more broader. Yeah, thanks, Phil. The broader definition of U.S. person, broader than 7701A30, the default definition. Foreign corporation is the standard definition. Control is where you're going to spend all your time to try and decide whether there's more than 50% control by voter value. And within that, constructive ownership is going to be the game. Let's go category 5. And so actually we're going to be launching into sort of a joint discussion of category 1 and category 5 here, because this is where RevProc 2019-40 comes into play, and the blowback of the Tax Cut and Job Acts and repeal of Section 958B4. So who is a category 5 filer? It's a U.S. shareholder. So remember, that's U.S. person, 10% or more of the stock. It's at any time during the tax year. So it doesn't have and it's got that last day of the year that it was a CFC. So again, you have 10% of the stock of a corporation. You sell it today, August 26, 2022, the last day that is a CFC because you sold all your stock. Well, I'm going to heroically assume, let's pretend the example is you own 100%. Then the last day it was a CFC was today, August 26, and therefore on August 27, it's a foreign corporation still because it still exists, but it's owned by somebody else. And by assumption, that person's not a U.S. person, and therefore off you go. So the question is, are you a U.S. shareholder? And it'll give you no end of pleasure, I'm sure, to find out that the definition of U.S. person is not helpfully expanded to include Puerto Rico possessions and people making the 6013 G or H election. It's just the generic description, who is a U.S. person. The standard definition of U.S. shareholder applies. And as usual, all of the hard work is in the constructive ownership rules. So let's move on and start talking about specifically RevProc 2019-40, because that's where they said, and now we've got categories B and C. And let's look at how it works. Now, again, background. This is from the preamble. Oh, no, it's not from the preamble, but it's from this section of the RevProc that was explaining why did we do what we did here. And so the government recognized, as you can see in the bolded language in the bottom 2 lines of this paragraph, said it might not be possible for you to figure out if this thing is even a CFC. And if you don't know if it's a CFC, how do you know if you have to file as a category 5 filer or not? So it said, practical realities do matter. And then they highlighted a second practical question, right? If you are a U.S. shareholder in a controlled foreign corporation, then you are going to take into your gross income your pro rata share of subpart F income or global intangible low taxed income. Um, and if you are in one of these situations where you're sort of sufficiently distant from the center core of this foreign corporation's activities, you may not have enough clout to extract accounting data out of this foreign corporation to figure out of all of its operations, do I have any subpart F income? Yes, no. Do I have any global intangible low taxed income? Yes, no. And if I do or don't, how much? Don't know. And so you would be unable to, even if you decide you are a category five filer, you wouldn't be able to complete the required schedules properly. So you'd be out of substantial compliance, and there's your instant $10,000 penalty. So they recognize this as a problem, a practical problem, caused solely by the repeal of Section 958B4. And why was 958B4 repealed? It was because Congress looked at 958B4, which was a modification of the Section 318 rules. And they said, oh, some bad things are being done by bad people to avoid taxes. Therefore, let's get rid of this section entirely. So, if any of you know who G.K. Chesterton is, early 20th century journalist and noted Catholic theologian, look up Chesterton's Fence. And he talks about the folly of the progressive performer who comes down a country road and sees a fence across the road and says, tear down this fence. And Chesterton says, before you tear this thing down, why don't you fully understand why it's there and understand the implications of what will happen if you tear down the fence? In other words, Congress doesn't know about second order thinking, or in other words, they don't know how to ask the question, what are the knock on effects of this if I do this? So they effed up a bunch of stuff by doing something dumb that was right at the edge of their nose. So what are you going to do? Not that I'm bitter about Congress or anything, but, and of course, I don't judge. So what are your choices? Well, I mean, your two choices, if you're facing a revenue agent who's saying, you have to file Form 5471 and you have to file the schedule attached to Form 5471, and you say, I have no way of getting that data. So what are your choices? Try harder. So, and that's not going to work. But I think the other way that the government said is, okay, we've got these safe harbors in 2019-40. And in fact, in some situations, we're going to waive the Form 5471 filing requirement entirely. So that's what RevProc 2019-40 did. I'm not saying it did it perfectly, but it did something. Here's your summary of what's going on in RevProc 2019-40. So you will be able to figure out category 1 ABC or category 5 ABC. So let's look at the column headings. You see at the first part of the column headings talks about share ownership. And there's a set of outcomes that happens when you have direct or indirect stock ownership in the foreign corporation. So direct ownership is your name is on the share certificate. Indirect stock ownership is like your name is on the stock certificate for holding company, and you're trying to figure out your reporting position for subsidiary. So you have indirect share ownership in the subsidiary. Constructive ownership is you have ownership because of the attribution rules from a foreign person. So there's an air gap. You don't have some sort of direct or indirect ownership. There's an air gap, but the government decides we're going to pretend that you own these shares anyway. Spouse, parent, stuff like that. The second part of the heading is this special phrase, and this is newly coined in RevProc 2019-40, foreign controlled CFC, or foreign controlled for category 1, foreign controlled specified foreign corporation. So these are the things, I own stock. How do I own it? In what? One of these foreign controlled things. And then let's look at the row titles on the left. This is a question of, are you related or are you unrelated? And the matrix matching between these two things will tell you what category you fall into. So, and you can see the little summary, and we're going to walk through it a bit so we can see what happens. But let's just back up and look at the philosophy of it. Look at that bottom right-hand corner that's turquoise. It says, if you only have constructive ownership, you don't have direct or indirect shareholdings, and you are, quotes, unrelated, whatever that means, and we'll talk about it in a second, then it's highly, highly unlikely that you are going to be able, as a practical matter, to get any data out of this foreign corporation. Because if you have constructive ownership through a foreign person, your granddad or something like that, the corporation is going to ignore you because you're not a shareholder. They can ignore you. And if you're, quotes, unrelated, and we'll describe what that means in a second, that means you're sufficiently distanced from the king's throne that they can, again, just ignore you. Say, who are you, punk? Go away. So in that case, the government has said, don't worry about it. If you fit in this category, you don't have a Form 5471 filing requirement at all, even though technically this might be a CFC, and even though technically you might be a U.S. shareholder. So that's the picture. And what we're going to spend our time on now is looking at those two yellowish, goldenrodish ones, whatever color that is. Related constructive U.S. shareholder. In other words, you're close to the throne of the king, but you're a constructive U.S. shareholder, meaning you're not in any way, you don't have shareholder power, right? You're a random person as far as they're concerned. And unrelated, Section 958 means that you are unrelated, you're distant, but you have this indirect power. So it's like the connection between the engine of the car and the wheels. You can trace from the engine to the transmission to the drive shaft to the wheels, and then the wheels on the bus go round and round. So here's a little example just to show you, and it's going to drop you into a category 5C filer. Look at this situation where you've got a non-resident alien person who owns the stock of a U.S. corporation and a foreign corporation. The downward attribution happens. And I'm looking section 318A, which is not modified by any code or reg. It says if 50% or more of the stock of one corporation is owned by the same person, well, you can read it yourself. You can read what I've rewritten here. So it says if 50% or more of the stock in U.S. corporation is owned directly or indirectly by non-resident alien, then U.S. corporation is considered as owning the stock that non-resident alien owns. So now, hey presto, by constructive ownership, this U.S. corporation owns 100% of the stock of foreign corporation. Therefore, U.S. corporation is a U.S. shareholder. Therefore, U.S. corporation has a Form 5471 filing requirement. And so foreign controlled, what you figure out for this purpose is you run the attribution rules two ways, with and without downward attribution. And if it's a CFC with downward attribution and it's not a CFC without downward attribution, then it's a foreign controlled CFC. So it's like CFC light. See, so I've given you the example here where it's a foreign controlled CFC here, because if we apply the downward attribution rules, we have to pretend that U.S. corporation owns the stock of foreign corporation. But if we don't apply the downward attribution rules of 318A3, then it's just a normal situation and it's not a CFC at all. The foreign corporation is not a CFC. So that's why foreign corporation is a foreign controlled CFC. And so far, we're squarely within the bucket of the definitions that RevProc 2019-40 is trying to solve problems for. Let's go on to this other one, the related question. So are you related or not? The RevProc tells you go to section 954D3. So they pulled a thing out and they said, and take that paragraph, and anytime you see the phrase controlled foreign corporation, delete it, insert the name of the person you're trying to figure out with, and see how it reads. And if it says you're related under that definition of related, then you're related, and if not, not. So here is the phrase. I'm giving the slide. I'm not going to read it to you because we're going to run out of time because this is complicated. But I've rewritten on slide 71, substituting the names in. So you can see taking 954D3B, United States Corporation is a related person with respect to a controlled foreign corporation. That's the foreign corporation. If such person is, ignore A, if United States Corporation is a corporation, and it is, which is controlled by the same person, non-resident alien, which controls the controlled foreign corporation. So this entity, the U.S. corporation in my little example, is related to the foreign corporation. Control means greater than 50%. So the conclusion is that U.S. corporation will be a Category C filer, and I've sort of written down all the things here because it's what's called a related constructive United States shareholder. So it's related because it's close enough to the common owner, but it's constructive ownership, not indirect or direct. And so again, just going back to this, it's the far right column, the little goldenrod thing. This is where you put yourself and you check the box 5C, and then you fill in the schedules that you're supposed to fill in for the Form 5471 filing. And with that, it's the end. I'm a minute over. My apologies. No brains are saved after 60 minutes. We'll see you next month, September 30, when we talk about direct and indirect constructive ownership for Form 5471. Thanks so much for watching, and goodbye.